and welcome to another episode of Straight from the Fund Manager. Joining us today is Vivek Sharma of Nippon India Corporate Bond Fund. Thank you, Vivek, for joining us today on the show. Vivek, to begin with, what is a corporate bond fund and who should consider investing in the Nippon India Corporate Bond Fund?
So a corporate bond fund as a category defined by the regulator SEBI is the one wherein you need to mandatorily invest 80% of your assets in long-term AAA and AA plus assets in form of corporate bonds. Remaining 20% of the assets could be in similar or lower rating. There is no restriction in terms of the duration profile of the portfolio, which is prescribed by the regulator. So it could be it can operate on the duration, any part of the duration curve as the fund is positioned. As far as Nippon India Corporate Bond Fund is concerned, we have positioned it as an intermediate duration product where the portfolio is a high-grade fund with 100% of its investments in long-term AAA assets. The portfolio has a duration band of 1.5 to 4 years, so it can move within this duration band. As far as the differentiation in this product, what we offer to investors is a good mix of sovereign AAA or a private AAA structured assets, wherein the idea is to generate a larger portion of the returns from the carry, plus to take advantage of the duration as and when the opportunity presents itself in the market.
Vivek, what are the underlying assets of the Nippon India Corporate Bond Fund?
Like I mentioned, the product is 100% long-term AAA rated. It's a mix of sovereign assets, AAA PSUs. So right now we have almost 80% of our assets in sovereign and AAA PSUs. Remaining 20% of the assets are in high-quality AAA private sector issuers and some bit of AAA structured assets. Currently, the fund has duration in excess of 7.5%. and running a duration of 2.5 years.
Vivek, what is your outlook on interest rates, credit spreads, and largely the bond market?
So on interest rates, I think in last 15 odd months, we have seen RBI hiking rates by almost 250 basis points, the repo rate, and has gone on pause in last couple of policies. Similarly, in global markets, again, we have seen US Fed has come and hiked rates by almost 500 basis points. This was largely due to higher level of inflation, which was there in global and domestic markets. Recently, inflation has moderated both domestically and globally, bearing last couple of prints in Indian markets where inflation spurted due to vegetable prices going up. But all in all, we believe post this see-through of last 1 or 2 months, I think inflation is on a glide path. I think the bar to raise rates further by RBI is very high. We might expect rate cuts happening over next 9 to 12 months if inflation follows this trajectory. Similarly, on the global front as well, markets are pricing in rate cuts by US Fed starting month of Feb 20 or March 24. So all in all, we are very constructive on the bond markets from here on, and we feel it's the right opportunity for investors to add duration to their portfolio. One, since the carry levels are quite high, which offer a cushion to investors in terms of any intermittent volatility which might happen in the market. And secondly, to capture any capital gains which might arise as and when the interest rates start falling going forward. Again, to answer your question on credit spreads, I think credit spreads have widened over last 12-14 months when the rates were going up and liquidity in the system dried significantly. As in when the rate cut cycle starts, we believe the credit spreads can shrink as a second round effect post the rate cuts.
Vivek, I want to talk about your portfolio specifically. Why is there a difference in interest rate observed in two different AAA rated bonds?
Okay, so whenever a security is priced, typically, there are three elements to it. One is the interest rate risk. Secondly, a liquidity risk. Third is the credit risk. So depending on, different kind of assets, a sovereign asset is one which is priced the best. Second, you'll find a AAA PSU, which will trade at some spread over the sovereign risk. So the liquidity premium of a sovereign and a AAA PSU comes into the picture, which is low on, say, a credit risk. Similarly, you'll have a AAA private rated issuer, which will have, a further spread over PSU in terms of the credit premium which market charges. And hence we find, different types of same rated assets being priced and traded differently in the market.
Vivek, given the potential impact of interest rate changes on bond prices, how do you actively manage the fund's duration? Can you talk to us about your duration strategy in more detail?
Okay, so like I mentioned, Nippon India Corporate Bond Fund has a wide range where it operates from 1.5 year to 4 years. Just to give perspective, uh, post-pandemic times, as we were coming out of the first wave of COVID, when interest rates were at the lowest, the fund was operating towards the lower band of its duration profile. We were running duration of 1.25 to 1.5 years as we expected rates to go up, and which in turn will result in mark-to-market losses in the portfolio. Hence, the portfolio was running at the lower end of the band. As we saw, rates going up by 200 to 250 basis points in last 1 year, we have slowly increased the duration from 1.5 to 2.5 years. And we look to add duration slowly from here on as we get more comfort on macroeconomic data and clarity from central bankers across the globe. So all in all, you modulate duration of the portfolio by buying longer end securities or selling longer and buying shorter end bonds. And also we do use derivatives in our portfolio in form of swaps, which help to hedge our interest rate risks in the portfolio.
Right. Vivek, how do you stress test the portfolio to assess its resilience in adverse market conditions?
So for stress testing, there is a defined framework which we operate with. Our portfolios are stress tested every fortnightly. We have a model portfolio which is constructed and approved by the regulator. Basis that model portfolio, we stress test our fund basis three parameters: interest rate sensitivity, liquidity risk, and the credit risk. And these three parameters are tested using data for last 10 years. So you have data across cycles in case, how yields have behaved over last 10 years. So we take the maximum impact era and test our portfolio. So which helps, in avoiding any unforeseen shock which might arise in the market to a larger extent, and the portfolio remains resilient in those times.
Right. Very lastly, Vivek, with the recent changes in taxation, there is now a level playing field between traditional instruments and corporate bond funds as a category. How do you actively manage the portfolio now?
Since these are actively managed products, the first thing is vis-a-vis any traditional instrument, you have a better ability to capture interest rate movements in the market dynamically in a corporate bond fund kind of a product. If rates fall, you tend to benefit in these kind of product vis-a-vis any traditional instruments. Secondly, the deferred taxation element, which is there in a mutual fund, since these products are suitable for investors who come in for 2 to 3 years kind of investment horizon. So you don't need to pay taxes or account for any taxation during the time you are invested in this product, which unlike a traditional instrument where you need to account for or pay for intermittent taxations. Thirdly, these products have liquidity which is inbuilt in for the investors. Unlike a traditional instrument, money is available to investors at any given point in time without being penalized for redeeming the money at any point in the time.
Right. Thank you, Vivek. Great talking to you on the show, and thank you for sharing your thoughts with the viewers on the Nippon India Corporate Bond Fund.
Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.